So the Federal Reserve is starting to cut rates again. People think this bull market will just continue forever and ever as long as the Federal Reserve is there to save the day with interest rate cuts. They think recession, war, pandemic, doesn't matter. The Fed will save the day. But here's the thing. These interest rate cuts will probably not stop this recession. In fact, I actually think it's predicting this recession. You don't believe me? Let's look at history. This is the federal funds rate. It's basically the interest rate set by the Federal Reserve. This data goes back to the 1950s. And note that these vertical gray bars represent recessions. And this blue graph is the interest rates. Let's see if we can find a pattern here. Let's start with the infamous 2008 recession. We had an increase in interest rates. They went up, plateaued, and then they started to cut. And guess what? Didn't save us from everything. We had the recession. They continued cutting rates and the recession got deeper. You might think that's probably just a coincidence or there's some reason for it. Let's look at another recession. The 2001 recession, the burst of the dot-com bubble. You had an increase in rates. They went flat. Rate cuts and recession. What do you know? So didn't prevent the recession or the stock market decline. The dot-com bubble burst gave us about a 77% decline in the NASDAQ. 2008, about a 50% decline in the S&P 500. You have to ask yourself why they're cutting rates. If everything's good, everything's okay, stocks are at all-time highs, why are they cutting rates? Why? Usually they cut rates because of economic weakness, and there's usually a lag effect with these interest rate changes. So as they start cutting rates because the economy starts to weaken, these rate cuts don't really boost up the economy immediately. So things start to fall, and they tend to be too late. This is actually how it usually happens. They start cutting rates. Everybody's excited about the rate cuts because everything's going to just keep going up forever and ever. No, it eventually ends. Over here, the late 80s, started cutting rates, boom, recession. Same thing over here. After they increased rates, they were cutting rates, boom, recession. Then there was another one not too long after. After they hiked the rates, they cut them again into a recession. It doesn't stop the recession. Now, COVID, that one was a little interesting. We did have a recession, but it was cut short because of a ridiculous amount of money printing. The money supply quintupled in a span of less than 2 years. And that created a high amount of inflation. That's when the Fed was saying it's going to subside, it's temporary, right? No, the inflation was bad. And I think it was actually worse than the government statistics. So do you think we're going to do the same thing again? Have a ridiculous amount of money printing and cut rates to near zero? I don't think so. COVID was too recent. Now the national debt is at $37 trillion. It's at about 120% of GDP. They don't have much room to go nuts with the money printer. So this is just the interest rates. We can see a pattern here. Another thing to look at with interest rates is the yield curve. If you don't know what it is, this one looks at the 10-year bond and it compares it to the 2-year. In normal circumstances, the longer-term treasuries are going to have a higher interest rate than the shorter-term ones. That just makes sense. If you're going to lend money to the government for a very long time, you're going to want a higher interest rate. But sometimes it does the opposite, where the short-term treasuries have higher yields. But what's interesting about that is it's actually one of the strongest recession predictors. And we can see that with this graph. It goes back to the 1970s. Anytime this line goes below the black line, that means the yield curve was inverted. And we can see a pretty clear pattern with this. You see an inversion of the yield curve, then it uninverts, and then you have the recession. Let's see again. When does it invert? Did it briefly here, but it really did it here. It inverted, uninverted, recession. Again here, inverted, uninverted, recession. Briefly here, it's clearer if you compare the 10-year to the 3-month. It inverted, and then uninverted, and recession. Look right here. Clearly, deeply inverted for a significant amount of time. Uninverted. The recession should be very close. So Looking at these metrics, the interest rate set by the Federal Reserve and the yield curve, this gives you a rough sense about the timing of a recession. Doesn't exactly tell you how deep it could be. If you want to look at that, let's look at the valuations. The Shiller PE ratio, it compares the stock prices of the S&P 500 to their earnings. So it's a price to earnings ratio for the S&P 500, essentially. And this data goes back to the late 1800s. The higher the number is, the higher the price is relative to the earnings. So if you're going to buy stocks, you want it to be a lower number. The median is 16.05. Right now, we're at 39. We recently crossed 40. This right here is the peak in 1929 before an 89% stock market crash. The Shiller PE ratio at that time was about 31. Today, we're above that. That is a little concerning, no? So you have the timing of the federal funds rate and the yield curve, and then you add the valuations, which tell you about how severe the recession could be. In other words, how large of a stock market decline it could be. We can look at other valuation metrics like the Buffett indicator. It was given that nickname because Warren Buffett said this is a pretty decent way to see where valuations are in the stock market generally. This takes the price of 5,000 stocks and it compares that to the GDP. This data goes back to 1971. The mean is about 85%. The peak of the dot-com bubble was 138%. Peak of the housing bubble, 106%. Today, 216%. That's, all-time high as far as this data goes back. That's kind of crazy. This doesn't mean stocks are going to crash tomorrow, but you can keep playing with fire. You can continue making money for a little bit longer. You can see those around you making money and you can have FOMO and try to keep making a little bit more, and just keep pushing it. Or you can play it safe. I'm not a financial advisor, so I'm not going to give you specific advice, but I'll just say I personally like the idea of treasury bills. Very safe. If the market crashes, that's about the safest you can be. I don't recommend that forever. I want to buy stocks at a good price, but right now it's hard to find good deals in the stock market. Treasury bills can give you a modest interest rate exempt from state income taxes. Warren Buffett, I'll say, I think he knows what he's doing, and his company Berkshire Hathaway is holding on to a crazy amount of cash in treasury bills, about $340 billion. He tends to do this before recessions because he sees that there aren't a lot of good deals in the stock market, so he just stacks up the cash. And right now, compared to his stock portfolio, his cash and T-bills pile is very high. It might be the highest percentage-wise. That ought to tell you something. I understand stock prices over the very long term will just continue going up, but there are times when you should take a second look because you could be stuck holding on to stocks for a decade, maybe a couple decades before you get back to where you were. That's a long time. And it's not just stock prices, but it's also real estate prices. If you compare home prices to incomes, it's right around all-time highs right now, going back to the 1940s. The peak of the housing bubble, home prices were about 6.83 times the median household income. Right now, it's above that, above the housing bubble. Stock prices and real estate prices, very high. So just be careful out there. Everybody's a genius in a bull market, and this bull market has been going on for a very long time. So it may feel like it'll just continue going on forever, but eventually it's got to end. You don't see who's swimming naked until the tide comes out.